Surbhi Shanbag, and we are Group 1 of the Strategic Management course from Section B of IMI New Delhi. The topic of our PPT is Fintech Industry Analysis. We are going to overview Fintech industry and analyze the field using some of the strategic management tools we have learned in the class. So if there's one thing that most of us need in our lives, it's the help with finances. We may complain and lament over the lack of education and financial literacy in our public education system, but complaining rarely leads to solutions. When we lack the knowledge we require, we turn to Google, knowledgeable peers, or financial advisors with their questions. But nowadays, individuals and businesses are looking to financial technology to provide essential help that may help them transform the way they approach money management. So, what is fintech? Financial technology or fintech is the digitization of financial services normally provided by bank, credit card companies, credit unions, investment banking, and other businesses within the finance industry. On the surface, this may look like logging into your bank account to see a monthly statement using a third party application. But if we look deeper, there are more financial technologies providing alternatives to traditional methods, further democratizing and segmenting the sector. A few main types of services include money transfer and payments, savings, investments, budgeting, financial planning, insurance, borrowing, and business accounting. In the recent years, adoption of fintech solution softwares by users has increased globally in every category. As one of the most commonly used fintech services, the total transaction value of digital payments was reported to be $980 billion in 2020. The fintech industry overall is experiencing 8.6% cumulative average growth that is projected to continue through 2023. Based on these institutions, it is broadly categorized into four main categories. Category A refers to the large and well-established financial institutions like the big banks. Category B refers to the big technology companies such as Apple, Facebook that are not exactly into the financial industry but can be active in financial services. Category C includes companies that provide the infrastructure or technology for facilitating certain financial services. And category D are the disruptors which are focused on innovative technology or processes such as mobile payments. Now, looking briefly into the history of fintech, we know that it all began in 1838 when the electric telegraph was introduced for the first time. In 1950, Diners Club released the first universal credit card, and in 1982, the world was introduced to Trade Plus, an online brokerage platform, followed by the first version of Bitcoin that was released in 2009, and in 2013, Google was first launched, followed by Apple Pay in 2014. Since then, we have seen more and more firms and companies come into the fintech space. Now I hand over to Kirti.
Coming to the risk analysis of the fintech industry. First point, tech boundaries. Many places in the world are not yet fully equipped to adopt fintech and its complex system. Consumers would like to know how their data is used, how to access it, and what happens to it, and how they should choose to withdraw it. There is also a high possibility of theft of funds. The majority of fintechs deal with a high frequency of funds movement, high volumes of payment transactions, and customer accounts, as well as the fast growth and implementation of new technology, leaves them vulnerable to theft. These thefts could be by an employee or an external party as well. Then cybersecurity. Cyber attacks collect vast amounts of personal data to carry out theft and fraudulent acts. Along with this, there are also a lot of advantages. For example, upgraded payment systems. An interesting benefit of fintech is to make business more efficient in terms of using invoices and collecting payments with higher accuracy. This not only offers more professional service, but also helps to enhance customer relations, increasing the probability of returning into a regular buyer. The financial institutions are expecting to provide customers with the most advanced security, high-end monetary services as well. To ensure that more people are confident in using financial services, it is important to use the latest security techniques. Moreover, taking advantage of the new mobile technology has resulted in major security investments. Fintech, it still needs to clarify how it offers a high level of security. If you're a fintech company with a lack of security, remember you're one step closer to destruction by a single security breach, cybersecurity infiltration, or data theft. Small businesses may lack the financial and human resources to deal with the fallout from this security breach. As a result, fintech companies often make significant investments in their security infrastructure, both online and offline. As a consequence, clients may be certain that their information is secure. Other advantages include that it has better transparency, it is cheaper and easier. Now I would request Vasu to take over.
Diving deep into the industry analysis, we are going forward with Porter's five forces for fintech industry. The competitive rivalry, since the market is tense with high competition and being niche in nature, fintech industry has a very high competitive rivalry. Fintech company usually offer a unique proposition of their own, hence having the power to hold the customer. Therefore, the bargaining power of suppliers in the fintech industry is high. Being a niche market, the fintech industry sees an evolved and informed buyer base. This customer is aware of its need and is also aware of the proposition offered to it. Hence, the customer always has an option to switch to a better proposition. This makes the bargaining power of buyers high. The fintech industry is totally and entirely dependent on technical and technological advancements. With the evolution of technology and tools, it becomes easier for a new entrant to enter the fintech space. This makes the threat of new entrants high. The fintech industry sees an evolved and informed buyer base. This customer is aware of its need and is also aware of the proposition which is offered. Hence, uh, the customer always has an option to switch to a better proposition given the different options that are offered to the consumers of fintech industry. This is why the threat of substitutes within the fintech space is high. However, externally there are no substitutes available to fintech products, which makes the threat of external substitutes as low.
I will start over with the best analysis for fintech industries, starting with political factors. Political factors is perhaps one of the least predictable aspects of any business. The stability of political system can affect the appeal of a particular local market. And so high global government stability can attract resources for industrial development as a whole, which will in turn enhance performance and progress towards competitive positioning. An increase or decrease in tax or change in interest patterns has a major effect on the demand of the company. Streamlining regular practices with global norms will help the country to improve its ease of development doing business, which is a very important parameter for global investors, as higher ranking simply means the regulations are simpler and there is a stronger protection for the company. Coming over to economical rights, the banking industry is totally closely linked with the economy. How closely, poorly, or how globally the economy is doing during recession will amount the amount of capital the banks can access. The quantitative easing policy of Federal Reserve will also have a global effect on the financial markets. 25% of 2019 funding went to companies which is headquartered in New York, while another 25% accounted for San Francisco. So globally, the companies are preferring 2 or 3 capitals overall. But several capitals have emerged as hubs for new fintech formations in the recent overall, including Singapore, Berlin, Austin, and Mumbai. Changes in interest rates can have an impact on how much a company can pay its international suppliers, leading to a lower profit margin. Growing global development and gross domestic product would highly indicate that the target market has a potential to penetrate. As a result of higher unemployment rates, the economy has less disposable income, which in turn affects the performance of companies. Higher consumer spending will also mean there is high purchasing power among the consumers, which in turn increases the overall consumption patterns and the health of the economy. As the COVID-19 pandemic continues to create uncertainty, many fintechs are under severe stress. But on the whole, the economy is shifting from a respond to recover pattern, which means there will be new opportunities created for fintechs and there's a tremendous growth for potential improvement. Coming out to social patterns, culture and how the way things are then affect the way how an organization culture perform and progress. A younger population base means it is very beneficial for fintech as it will allow the company to have a larger consumer population base. And as the population is aging, fintech penetration requires larger efforts. Higher education and awareness level means the consumers will be knowledgeable of what the product promises and they can make well data-driven decisions, which will lead to customer retention. Because of changing consumer behavior, companies face challenges from the demand side, and hence fintech companies need to face more influences by social factors to add newer digital channels to their business models in addition to the traditional channels which they follow. Now my colleague Anand will focus on the tail part of the pistol analysis.
Now let's have a look at the technological factors that impact this particular industry. First being is the mobile phone and internet penetration. Increasing competition and technological progress encourage traditional financial institutions to improve their systems, giving fintech opportunities to grow and prosper. High internet penetration has helped the fintech industry in improving its quality and delivery, as well as allowed it to engage in strategic communications and marketing processes. Second is blockchain. The most crucial problem of transparency can be solved by the appropriate use of blockchain technology, which can transform regular financial processes into secure and efficient transactions. When utilized correctly, blockchain has the potential of creating a fintech ecosystem, revolutionizing finance completely. Third being is AI. Artificial intelligence in fintech can be used for making decisions with regards to the lending process, consumer support, fraud detection, credit risk assessment, insurance, wealth management, and many more. In this era of digitization, modern fintech companies adopt AI to improve efficiency, precision, and query resolution speed. Now let's have a look at environmental factors. Fintech is in its original form is itself a sustainable alternative to the traditional finance sector by allowing people to manage their finances digitally rather than depending upon proper statements and physical bank branches. One example being is that Sweden, which has allowed users to track and measure the CO2 emissions associated with their purchases using their latest payment cards, helping them giving in their contribution to limit the climate impact of their spending through climate savings and climate refunds from partner brands. Such technology possesses both a challenge and an opportunity for fintech in India. Consumers like the opportunity to track and manage their carbon footprint, while manufacturers can brag about their environmental credentials and profit from any uptake in sales. Fintech can assess real-time public opinions regarding sustainability through AI analysis of millions of unstructured data. Now let's move over to the legal part. Employment law, anti-discrimination law, health and safety laws are all in place to monitor the basic functioning of the fintech sector, ensuring the prosperity of people employed in it. The Reserve Bank of India Act of 1934 governs all NBFCs. As per the terms laid out in this act, any organization providing fintech services in India will have to be registered by the RBI. According to Section 45(1)(I) of the RBI Act, no NBFC can start or run the business of a non-banking financial institution without first obtaining a certificate of registration from RBI. In 2020, the RBI issued the guidelines for payment aggregators and payment gateways, pursuant to which payment aggregators are now required to obtain a license from the RBI. Now my fellow colleague will take
firms which are making headlines in the finance industry. Its business strategy is based on pay through mobile concept and functions out of virtual banks and marketplace models. One major benefits of Paytm is digital wallets, which allows cashless transactions. Coming to customer segmentation, who are on the go, who enjoys convenience of e-wallets, and users of mobiles forms the basis of this segmentation. The revenue model of Paytm is commission-based earning through Paytm malls, listings, add-on platforms, mobile recharges, etc. The key activities include fund transfer, investment portfolios, wallet services, and e-commerce. Paytm websites, Paytm apps, client and vendor sites are some of the commonly used channels. Coming to SWOT analysis, we will first discuss the strengths of Paytm. Paytm has had an advantage of being the first online payment provider to set up shop in India. The timing was so impeccable since they began operations at the same time that smartphones were launched, because of which they became very popular. Secondly, Paytm has partnered with over 3 million retailers across India, and this has proved to be a convenient buying choice for many clients. Paytm also offers a wide range of services, allowing users to do almost anything they want online, be it reservation, retail, or recharge services. Lastly, it is highly convenient to use Paytm because it is available 24 hours a day, 7 days a week, and allows for simple payments and transfers of money at any time and from any location. Weaknesses. One of the major weaknesses of Paytm is the lack of proper IT infrastructure, which is extremely important if they want their functionalities to be reliable. Secondly, the users are uniformed of what Paytm can accomplish for them and are unsure of how to utilize the app. The majority of Indians are accustomed to transacting with cash and have yet to adjust to cashless purchases, which cause hindrance to Paytm's growth. Another major weakness is Paytm's poor customer service. The app and portal caters to a wide range of people and clients, but are incapable of managing many inquiries. Lastly, the Paytm wallet business model can be easily replicated even with the number of patents and copyrights the company possesses. Opportunities. Aggregators and middlemen are highly in demand everywhere these days. People prefer to make most payments from the comfort zone of their homes as technology advances, and thus this can be a great opportunity for Paytm to expand. With the increase in digitalization, services like Paytm have a great chance to grow. Example, during demonetization, Paytm was one of the main beneficiaries of the Indian government's drive. Thirdly, the increase in the number of working professionals and consumer disposable income can greatly help to the giant to develop. Lastly, Paytm wallet can explore adjacent industries to further market growth, especially by extending the features of present products and services. Threats. Due to poor data security, there's a sense of uneasiness among users regarding the security of information provided to the Paytm portals. This could prove to be a major threat in the long run. Secondly, with decreasing entry barriers, every new entrepreneur is considering aggregating services. There are numerous online payment portals, and even telecom service providers have started offering online payment gateways, thus leading to an increase in competition. Lastly, payment wallet should keep a close eye on the fast-changing government regulations regarding environmental and labor safety laws. From here, Vartika will take the lead.
With the vision to revolutionize the online payment mechanisms, Razorpay was launched by Shashank Kumar and Harshal Mathur in the year 2014, and it charges 2% fees on every transaction made through their gateway. With the emergence of Razorpay 2.0, the company has seen a growth in its revenue streams. It now contributes about 30% of Razorpay's total revenue generation. The online payment market is fairly crowded when it comes to ventures operating in the sector. In a market scenario like this, Razorpay competes with both well-established new entities like PayPal, Citrus Pay, etc. Razorpay has acquired 3 companies as of December 2021. The acquisitions of Terra Labs that came in on July 19, 2021 mark the last of the acquisitions of the company. Now coming to the SWOT analysis. SWOT analysis helped us identify various aspects of Razorpay conducting its business. Using the platform, it gives us various advantages. The platform, which is available for both online and mobile applications, provides a full dashboard for managing payments for customers. Razorpay's biggest benefit is its wide selection of payment alternatives, which allows consumers to finish their transactions using their preferred way. Also, its checkouts have a straightforward and easy to understand visual design. All they need is a single line of JavaScript to execute in any e-commerce system. To top it all, Razorpay makes mobile consolidation simple. However, there are certain areas which require work for Razorpay to grow. Razorpay says that its customer care is available 24/7 via chat support and IVR. Nonetheless, there are a number of customer service issues like a lack of hotline number, etc. Electronic transactions are unmistakably simple, practical, and suitable. Even so, it comes with a certain level of risk. The internet and a fast connection are required for the full transaction mechanism for sending and receiving money, as well as for creating an account. Razorpay services, on the other hand, would be ineffectual in emerging economies and nations where internet access is limited. Also, the TDR rates of Razorpay for payment gateways are slightly higher than the other companies. With strengths and weaknesses, opportunities and threats can be easily identified for Razorpay. Talking about opportunities, digital cryptocurrencies are becoming increasingly popular, giving Razorpay the option of launching or accepting this money. India and other developing economies are attempting to go cashless or minimize their reliance on money. It's a tremendous opportunity for Razorpay to grow. As more and more firms set up online stores, Razorpay would do well to leverage its already strong developer-friendly integration suite. Certain areas, however, are still a roadblock in Razorpay's journey to reach the top. Major competitors are PayU, Paytm, Citrus Pay, InstaMojo, etc. Cash and brick-and-mortar transactions will also be considered as the major competitors, as India still largely remains a cash-based economy. Some nations have rigid rules and regulations that make it difficult for corporations like Razorpay to set up shop there. Razorpay does offer an ePOS mobile app, but it requires manually inputting the card number, which is a time-consuming procedure that will not catch on as we move closer to seamless payments. Now, Vasu will take this forward.
Now we move on to competitive analysis and comparison of Paytm payments and Razorpay. While Paytm and Razorpay have been primarily functioning as the payment partners of a variety of businesses, both the companies have significant differences in their primary business model. Paytm utilizes payment portal, e-commerce, and UPI to make payments. Razorpay has been primarily a merchant-side payment partner based on traditional digital payments, which include cards, net banking, and internet banking. Paytm has the payment bank set up along with a whole lot of benefits for both merchants and customers. But Razorpay, on the other hand, offers only the payments portal and small benefits to merchants alone. Another competency of Paytm is that it offers customized plans for businesses based on their company size and needs. Razorpay, until very recently, had just a standard plan for all businesses. Another development for Paytm is that Paytm Wallet and Paytm UPI have now been listed on the Paytm payment pages that customers see after the checkout page. Razorpay still happens to be the backend of majority payment portals. Now I ask Surbhi to take the slide forward.
So now we will be talking about the future trends in the fintech industry. Analysts have predicted a large number of trends in the fintech for the future and also the other trends that would facilitate the growth of this sector. We see a trend of large number of financial firms taking aggressive action to determine how they can use technologies within their ecosystems, leading to the development of more and more fintechs. All in all, there is a considerable turn of traditional financing firms turning themselves technologically savvy. Then comes blockchain, which actually eliminates the need of a central intermediary to do asset transfers. And asset transfer aren't limit, and these asset transfers aren't just limited to money. Blockchain compresses all the steps into one step that can be done within a few seconds or minutes. There's been progress to help even the regulators keep pace with and even foster blockchain innovation. In places such as in Singapore, Australia, UK, US, regulators are actively looking to set up sandboxes to test scenarios and identify how the technology can be leveraged to solve problems. Now, coming to the operational changes, fintech and other emerging disruptive technologies generate excitement, but with this disruption also comes changes to existing architecture and the creation of new implementation and deployment changes. So there's this broad recognition that technologies can be used to solve certain problems, but financial operations and services are complex. And these solutions aren't point-click technologies that can be implemented in a day. So we are currently in the realist phase, but financial executives will have to figure out how to incorporate and apply new technologies as well as short and long-term impacts on the existing systems. It's always harder than you think, but with strategically taken decisions and risks come significant rewards. Now, coming to the technical part, the new trend right now and for the future is automation. And so far, it's been mostly used in customer service applications. While freezing up humans to provide better and more personalized services, the chatbots interact with humans in real time to give them the information that they need when they need it, leaving them with higher customer satisfaction. In future as well, voice recognition will probably be used a lot more than it is used now in customer service as smart home devices increase the demand and use for hands-free banking. Financial institutions are already using cloud services for human resource and CRM platforms for data storage. While the above trends improve the quality and service speed of services, they increase security concerns and risk of cybercrime. AI has already helped with fraud prevention and identify theft detection, but cybersecurity will be of great concern as technologically advancements bring new risks. In coming years, financial institutions will be forced to invest heavily in the cybersecurity. In the last 10 years, financial institutions realized that millennial financial goals are very different from those of the older generations. They are more likely to seek rent to own agreements, mortgage, debt management solutions more than they would seek business loans. Hence, institutions are more likely to use technologies to satisfy the millennials who will be at the forefront of banking. So with these, we conclude our presentation on the fintech industry. Thank you.